2025's looking like it's going to shake things up in the market. If you want to stay one step ahead, these 5 ETFs might just be your golden ticket to some killer growth opportunities in this wild financial ride. Hey everyone, glad you're back on the channel. Today we're talking about something super exciting, the top 5 ETFs for high growth in 2025. If you're aiming to supercharge your investment portfolio, you've come to the right spot. ETFs, or exchange-traded funds, are basically your best friend if you want to diversify your investments without breaking a sweat. They let you invest in a bunch of stocks or assets all at once, which means you're spreading your risk while still chasing that growth. In a market that's all over the place, picking the right ETFs can make all the difference. We've done the legwork, checking out trusted sources and expert analysis to give you the straight talk on these opportunities. All fact, no fluff. We'll explore some real, actionable picks that could give your portfolio a nice boost. So, get comfy, maybe grab a pen, and let's dive into these ETFs that could make your 2025 your best year for investing yet. Chapter 1. What makes a great ETF in 2025? When it comes to choosing ETFs, not all are winners. So what should you look for in 2025? Let's break it down into 3 key aspects: cost, risk, and what they're invested in. First off, those expense ratios. They're like sneaky fees of investing. The lower they are, the more cash stays in your pocket. Studies from Morningstar shows that funds with lower expense ratios tend to do better over time. Then there's your risk tolerance. It's all about knowing yourself. Do you get the jitters with market swings, or are you in it for the long haul, aiming for higher growth? ETFs come in all sorts, from those that shoot for the moon to those that keep it steady. Lastly, market exposure. What's your ETF actually betting on? Tech stocks, small companies, or maybe looking abroad? For instance, small caps could soar if interest rates dip, while sectors like utilities might be your safety net during economic turbulence. In 2025, smart diversification in ETFs will likely be the name of the game. It's not just about chasing the highest returns. It's about balancing growth with stability to match your personal investment style. Stick with me, because we're about to get into the nitty-gritty of the top ETFs that tick all these boxes. Chapter 2. Top 5 ETFs for 2025. Alright, let's dive into the cream of the crop. The top 5 ETFs you should consider for your 2025 investment strategy. Number 1. Schwab US Small Cap ETF, or SEHA. First up, we've got the Schwab US Small Cap ETF, or SEHA for short. This is your go-to if you're into those small companies with big potential. With an expense ratio that's just a whisper at 0.04% and an average annual return of about 9.1% over the last decade, SEHA is like your wallet's best friend. Why small caps? Well, if interest rates dip or if there's more deregulation, these smaller companies could hit the jackpot. SEHA lets you ride that wave without the roller coaster of picking individual stocks. Number 2. Schwab US Dividend Equity ETF, or SEHD. If you're all about that dividend life, the Schwab US Dividend Equity ETF, SEHD, is your jam. It's all about those big, stable companies like Cisco, Home Depot, and Verizon that love to share the wealth. With a slightly higher expense ratio of 0.06%, you're still getting a lot for your money, especially if you're looking for income alongside growth. Dividend stocks can be your anchor in stormy markets, providing a bit of calm with their steady payouts. Number 3. iShares Core S&P Total US Stock Market ETF, or ITOT. Looking for an ETF that's like a Swiss Army knife for your portfolio? Check out the iShares Core S&P Total US Stock Market ETF, ITOT. This one gives you a slice of everything, from tiny startups to massive corporations. With an expense ratio of just 0.03%, it's one of the cheapest ways to own the entire US market. But remember, it's heavily weighted towards the tech giants, like Apple and Microsoft. That's great when tech's rocking, but if they dip, it'll affect your whole investment. Number 4. iShares Cybersecurity and Technology ETF, or IHAC. Now let's get into the nitty-gritty of cybersecurity with IHAC. This ETF focuses on companies at the forefront of digital defense, like Palo Alto Networks and CrowdStrike. With the world going more digital by the day, cybersecurity isn't just trendy, it's essential. Yeah, the expense ratio is a bit higher at 0.47%, but think about it. You're investing in an area where demand isn't slowing down anytime soon. Number 5. Vanguard Long-Term Treasury ETF, or VGLT. Last but not least, the Vanguard Long-Term Treasury ETF, or VGLT, is your safe harbor. It deals in long-term U.S. Treasury bonds, with maturities stretching from 10 to 25 years. If you're expecting rates to go down in 2025, these bonds could be your golden ticket, as their value tends to rise when interest rates fall. And again, with an expense ratio of only 0.04%, you're not breaking the bank to get this kind of stability. These ETFs mix growth, income, and a little bit of safety, all while keeping costs down. Whether you're planning for aggressive gains or just want a smoother investment ride, there's definitely something here that'll fit your strategy. Remember, the key is not just to chase returns, but to build a portfolio that works for you over the long haul. Chapter 3. Key Considerations for ETF Investing in 2025. Alright, we've talked about the top ETFs. But before you dive in, there are some things you should think about. Picking ETFs isn't just about following the crowd. It's about making sure they match what you're aiming for and keeping an eye on the big picture. First off, sector exposure. If you load up on tech or small caps, you might end up with all your eggs in one basket. Sure, they can offer big growth, but too much of a good thing can increase risk. Balance is crucial. Then there's the macroeconomic stuff. Interest rates, inflation, and policy changes can shake up your ETF's performance. For instance, if rates fall in 2025, long-term treasury ETFs like VGLT might see a boost, and small caps could take off as borrowing becomes cheaper. And don't overlook the costs. Low expense ratios from ETFs like SEHA or ITOT mean more money stays in your pocket. Over the years, that can add up. Investing in ETFs is about playing the long game. By considering these factors, you're setting yourself up to make smarter choices that fit your financial dreams. Chapter 4. How to use ETFs in your portfolio. ETFs are like Lego bricks for your investment portfolio. The trick is using them smartly. First, define your goals. Are you after explosive growth, reliable income, or a blend? Your allocations should reflect that. If you've already got lots of tech, consider balancing with something like SEHD or VGLT for some stability. Or if you're chasing growth, ETFs like SEHA or IHAC could be your go-to. The magic of ETFs is their adaptability. With a right combination, you can customize a portfolio that's uniquely yours. So there you have it. 5 ETFs that could really make your 2025 your year for investing. Whether you're chasing growth with SEHA or IHAC, or looking for some income stability with SEHD and VGLT, there's something here for everyone. Remember, the big takeaway is to diversify smart, watch those fees, and make sure what you choose fits your personal goals. If this video sparked some new ideas or helped you with your investment game plan, Give it a like and hit that subscribe button for more practical advice. Got questions or your own ETF favorites? Drop them in the comments. We're all ears. Catch you in the next video.